Today we're diving deep into decentralized finance, better known as DeFi. This space has been creating a lot of buzz, and I get it. There's a ton of potential here. But is it truly the future of finance or just another trend? Let's break down what DeFi really is, what makes it appealing, and what the risks are. So let's start with the basics. What is DeFi? DeFi, or decentralized finance, is a financial system built on blockchain technology, mostly on Ethereum right now. It's all about taking the services banks offer, like lending, borrowing, trading, and earning interest, and creating a way for people to access those without needing a central authority like a bank or a brokerage. Instead, these activities happen peer-to-peer on a blockchain. In DeFi, all you need is an internet connection and a digital wallet, no middlemen required. Now let's look at why DeFi has so many people excited, starting with accessibility. This is huge. DeFi opens up finance to people who don't have access to traditional banking. Think about it. There are millions of unbanked people around the world who can't get loans or even basic savings accounts because they don't meet the criteria or live in an area with limited banking infrastructure. With DeFi, those barriers are removed. There's no need for a credit score, no lengthy paperwork, and no local bank branch. Just an internet connection and a digital wallet, which can be set up in minutes. Next, transparency and control. Traditional banks and financial institutions operate mostly behind closed doors, but DeFi operates on a public blockchain. This means every transaction is visible to anyone who wants to look, creating a level of transparency we rarely see in traditional finance. Beyond transparency, DeFi gives people more control over their money. When you use DeFi, you're not handing your assets over to a bank. You control your digital wallet and your funds, and you're not relying on a bank or any other third party to make sure your money is safe. Then there's the potential for higher returns. In traditional banking, you're lucky to get even a small interest rate on savings. In DeFi, you can earn significantly more through something called yield farming or liquidity mining. Essentially, you're providing liquidity, meaning you're lending your assets to the DeFi platform in exchange for rewards. These rewards can be a lot higher than what you'd see in a savings account or even in many investment portfolios. However, these returns come with risks, which we'll talk about later. And here's another thing that's drawing people in: innovation. The DeFi space is constantly developing new tools and financial products. It's a rapidly evolving ecosystem, and that pace of innovation means there are always new ways to interact with your money. Smart contracts are a big part of this. They're programmed contracts that automatically execute transactions, like lending or borrowing, without needing a human to oversee the process. This automation means things can happen much faster and cheaper than in traditional finance. Sounds pretty good, right? But as you'd expect, there are risks and drawbacks, and these are important to understand. First up, volatility. The DeFi market is extremely volatile. We're talking about price fluctuations that can be a roller coaster. The value of digital assets can change drastically in a very short time, which can mean big gains, but also serious losses. And unlike traditional investments, DeFi doesn't have the same safety nets or insurance, so you really have to be prepared for that level of risk. Another major risk is the lack of regulation. In the world of DeFi, there's no FDIC to back your money and no SEC to regulate transactions. Traditional financial institutions are required to meet regulatory standards to protect consumers, but DeFi doesn't have that kind of oversight yet. This means if a DeFi platform fails or a hack occurs, you're pretty much on your own. There's no one to help recover your losses. This lack of safety net can be a big concern, especially for people who are used to more secure traditional finance options. And that brings us to security risks. While smart contracts are powerful, they're not flawless. Smart contracts are just pieces of code, and if there's a vulnerability or a bug, it's open for anyone to exploit. Unfortunately, DeFi has seen numerous high-profile hacks where millions of dollars were lost overnight. Once funds are stolen in DeFi, they're nearly impossible to recover, so the security risk is real. Finally, there's the complexity of the space. For beginners, DeFi can be pretty overwhelming. You're diving into terms like staking, liquidity pools, yield farming, and understanding these concepts can be a real challenge. Plus, you need to be comfortable with using a digital wallet and understanding how blockchain transactions work. It's a different world compared to just logging into your bank account. This complexity can be intimidating and, if you're not careful, can lead to costly mistakes. So, is DeFi the future or just a fad? Honestly, it's a bit of both. There's so much potential here, especially for people looking to take more control over their finances, find alternatives to traditional banking, or just explore new opportunities. But like any financial decision, it's essential to weigh the pros and cons carefully. Do your own research, understand the risks, and don't put in more than you can afford to lose. If you found this helpful, be sure to subscribe for more insights on finance and innovation. Stay informed, stay cautious, and as always, stay empowered. You need to hear this. You need to hear this.